This is Asia Trade. I'm Shery in Tokyo. The top stories this hour. Asia poised for gains as the Iran truce sends U.S. stocks and bonds higher on hopes of easing inflation risks. Brent crude holding below $80. Shipping returns to the Strait of Hormuz as the U.S. downplays concerns that Iran will eventually be able to charge tolls. Plus, talk of new chip deals boosts Amazon and Intel, while Bloomberg learns SpaceX is preparing a $20 billion bond sale hot on the heels of its record IPO.
I'm Haidi, Stroud-Watts in Sydney. Take a look at the setup for trading across Asia. What looks like a pretty happy Friday when it comes to risk sentiment as we have more progress, at least being touted when it comes to the US-Iran interim peace deal taking effect. Shipping returning to the Strait of Hormuz, the US declaring an end to its blockade as well. But we do know that 60-day clock starts for working out details. But the US at this moment downplaying concerns that after the 60 days we could still see the imposition of Iranian tolls on traffic through that strait. But take a look at how we've set it up when it comes to that lead from Wall Street overnight. S&P 500 up by 1% there. We're seeing Kospi futures looking pretty bright, particularly when it comes to some of the further developments in the chip story. Shery mentioned Amazon in those talks to sell its AI chips for other companies' data centers, which could impact, of course, the business for NVIDIA. But looking at those chip players into the Japan and Korea sessions in particular, the yen holding pretty close to that 2024 low. So we're continuing to watch out for the prospect of intervention. But switching out the boards to take a look at the oil piece of the story, because, of course, this is the broad risk-on sigh of relief that we're seeing across various asset classes. Brent crude previously trading high by about 0.4%. Not too much of a move for New York traded crude at the moment. If you take a look back at the weekly picture, though, a pretty big weekly drop as we have that resumption of shipping through the Strait of Hormuz, the US Central Command lifting its naval blockade as well. But, of course, some of that caution could be down to the fact that that longer full reopening in the long term could be quite a drawn-out operation. But as I mentioned, Korea, Japan firmly in focus. Many markets in the region closed. The US is also on a holiday on Friday. Let's take a closer look at what to expect as we round out the week. Our Bloomberg Markets reporter Anthony Stevens is with us. Anthony, what's top of mind for you this Friday?
It was a really busy session in the US overnight. It's the biggest options expiry in recent memory, alongside an S&P 500 quarterly rebalance. This led to kind of a round of short covering on the back of some pretty decent tech headlines. So you saw the SOX index up 6%, and that's leaving some pretty good leads into Asian equities, at least in Japan and Korea. Korea especially up 3.5%, as Micron was up almost 10%. So it's a very strong tape for tech, and that continues a big trend of tech outperformance, especially on semiconductors, that is keeping dispersion within the S&P 500 around record levels. And that's important because that gives retail investors in the US tremendous conviction to keep chasing these tech names higher. For example, Marvell has been pushed into the S&P 500 actually on that rebalance yesterday. So coming into Asia, it really does look like tech is the only thing that is offsetting the increased hawkishness out of the Fed. Now, that's playing out in an interesting way across Asian markets, where you see Australian and Chinese futures lag versus the strong tech leads in Japan and Korea.
What's going on when it comes to currencies, right, and the impact on EMs in particular in Asia? Because we're seeing this resurgence in the US dollar now.
Yeah, and that's playing out on a cross-asset basis. So the chances of a hike in July actually moved up materially with extreme futures activity in the August contract. Now, in the BBDXY, which is the Bloomberg Dollar Index, it's found a level and is looking to break out of a multi-year range. If that does happen, that will put significant pressure on Asian FX. You already see the yen trading materially weaker than so-called intervention levels. The Korean won has given up a lot of its intervention gains, and we come into genuinely emerging markets in the back end of our session. Indonesian rupiah and Indian rupee. It'll be very interesting to see how they trade. The rupiah coming off a rate hike. Gold and Bitcoin were also under pressure as dollar trades. So the dollar is really rampaging against anything else that is not tech.
The oil story is quite interesting, isn't it? It almost feels like a bit of a shrug at the moment. Is this because we are seeing the markets wanting to know what happens after the 60 days?
Yeah, I think the oil markets in the region are leading the global price of oil. So, for example, Dubai and Omani crude is now trading in contango, which means there isn't any futures premium to holding this oil. So the market is getting flooded or has an expectation of getting flooded by Gulf oil. And these benchmarks are traded in the region. So the assumption is that traders in the Gulf know what they're doing. And that is the signal to the market as a whole that oil volatility has to come down. And we've seen that happen materially. Oil volatility is back below the 40 handle, which, to give you some context, is half the volatility of the Kospi index. So in terms of market concerns, oil has really faded into the background.
Anthony, do stick around because we want to take you to the other big story that we're watching today, and shipping now beginning to return to the Strait of Hormuz after the U.S. blockade ended as part of an interim peace deal with Iran. But concerns remain about whether Tehran might eventually charge fees on vessels. Vice President J.D. Vance skirted questions about potential tolls in the strait after the 60-day negotiating period.
That's not about tolling. That's about ensuring that the straits are never used as a choke point for the global economy ever again. It's frankly not what the Iranians want. It's not what the Omanis want. It's not what the GCC wants either. So what we're going to do, of course, working with our allies in the region, is to ensure that that is reflected in the final deal. And if that's not reflected in the final deal, there's not going to be a final deal.
Let's bring in Bloomberg senior editor Derek Wallbank, and of course Anthony is still with us. But Derek, let me start with you, because the problem now is implementation risk and whether the risk of tolls being repackaged as something else, as service charges. How big is this?
Well, Shery, you can call a toll a tax, a fee, a service charge, whatever you want to call it. But the simple fact of shippers and world commerce as a whole having to give Iran money to move things through what has been a free international waterway is one of the key, I think, concerns that people have coming out of this. Now, J.D. Vance, as you played the clip there on air, said very strongly if the strait's not fully open, there's not going to be a final deal, but the devil's in the details, and we have about 60 days to start working out these details. Now, that may be extendable, so it might not be a firm 60 days, but the clock is ticking on this. There is a lot of detail. Now, bear in mind, these sorts of agreements that we're talking about between the U.S. and Iran hinge on just hundreds of just tiny little things and little details. And the last deal between the U.S. and Iran, the Obama administration deal that Trump pulled out of, that took about 2 years to kind of get together. We're talking about doing this in 2 months. There is a lot to be getting on with.
Anthony, I know that you don't necessarily like to talk about the Iran war having implications or at least big repercussions for the markets anymore, but I gotta ask, when it comes to oil, are traders getting a little bit ahead of themselves? They seem to be pricing a quicker normalization here.
There's another two moving parts aside from the situation in the region, and that is the fact that Wash is very committed to looking through transitory inflation. So the impact on the rates market and the FX market and the price of money from the pop in oil has started to be mitigated somewhat. He's sticking very much to that message and also getting ahead of the problem by signaling a short and sharp rate hike. So in terms of oil's ongoing impact into U.S. inflation and markets, Wash has handled it from the US side of things. Now, closer to our shores, you have China's demand falling off a cliff because of this ongoing transition into electric vehicles. So in terms of Asia, and also India is following suit very quickly by transitioning to coal. So in Asia, you're seeing demand substitution by EVs in North Asia and with coal in South Asia that is pulling out some of the economic pain. So now we are back to a regime where, yes, it is a source of significant human discomfort, but the markets have discounted a lot of the impact already, and the focus has shifted to what trades can survive a higher rates regime in the US. That puts the focus very much on the tech trade as opposed to the oil trade.
Derek, we do have some lines coming through from remarks made by President Trump to the Axios show, really kind of being quite defensive and saying that he had not learned anything about limitations to his power when asked whether the sort of negotiation and the war process had sort of, I guess, humbled him in any way. Behind the scenes, though, there's plenty of internal criticism of this deal, as we've seen a lot of those sort of earlier maximalist demands being watered down.
Yeah, that's right. Now, Donald Trump has every incentive to sort of claim victory here. Some have said politically that this has been a superpower of his, that he can take any sort of situation, claim victory, and move on. And indeed, the president is trying very hard to paint this in the most positive light. I think that a lot of observers looking at this look at the final deal that he got. There's a lot of comparisons to, as I said, the Obama deal there in terms of what he got and what Obama got. A lot of it is somewhat the same. You could say that Iran, particularly discovering sort of what it can do vis-a-vis Hormuz, may have come out in a stronger position than it had been before. We've heard that there, and you gotta be looking at this as well. From Trump's side, he's been the undisputed kingmaker of the Republican Party in the United States, but he is just hearing it from a lot of his allies on the right, thinking that he got, in some sense, played. Now, there has been some, as I said before, there's a lot of still details to be done here, and you can already see the White House put forward J.D. Vance today in the U.S. Day, telling reporters about this deal and sort of defending it there. This has been a big Vance push, and Vance is going to be somebody who's going to be entrusted to be at the top line of this going forward to try and get these details done. But make no mistake, this White House is very much trying to defend this as a win going forward, when I think there is a deep-rooted amount of skepticism here. They're going to want to see, you've seen immediately Trump start going on to the economic idea on markets to really try and defend this. The idea that oil prices are coming down and that U.S. retail gasoline and diesel prices are going to come down as a result. You're going to see the White House keep returning to those sorts of themes and start talking there. And you've also seen, I thought was interesting, that the argument that Vance is sort of pushing back against is not necessarily one Democrats have been making, but is one that that some of the more hawkish folks have been making. The idea of, well, we needed to seek a peace at some form. You can't do this forever, things like that, and kind of shifting that baseline against when things are compared. So not to a pre-war baseline, but instead to a baseline of what might have happened had this continued to go on for another couple of weeks or months.
Derek, this must be quite a relief for Gulf states. What's been the reaction so far, not only amongst economies in the region, but also, of course, among U.S. allies?
Well, I think cautious optimism is one of the things that I keep seeing from a lot of folks. We're seeing some Gulf states talking about increasing their oil production, talking about, let's try to get things go back to normal here. I do think, as I say, devil in the details. Let's see what winds up coming out. If you're, someone who is kind of upstream of the Strait of Hormuz, and the Strait of Hormuz is between you and the open seas, it's in your interest to make sure that that is open and flowing. At the same time, I think one of the lessons that we've gotten over the last couple of months is that you have seen a lot of states talk about what they might need to do in order to sort of structurally prepare for taking this as a vulnerability down a little bit. Saudi Arabia obviously has a pipeline to the other side of the country where they can move flows. But I think that's going to be one of the things that you look at coming out of this, because this is one of the lessons we're seeing from a lot of the geopolitical uncertainty that's come out in the last year and a half, is that when that happens, you start seeing countries talk about what structural changes can we make going forward. So I think you've got to be watching for what pipelines might start getting discussed to other areas, and things like that, to try and mitigate some of this pressure point that has clearly been exposed over the last couple of months.
Bloomberg senior editor Derek Wallbank there, and of course our markets reporter Anthony Stevens. We have plenty more ahead. Bloomberg learning that SpaceX bankers are preparing a bond sale that could top $20 billion just days after the company's record-setting IPO. More on our story next. This is Bloomberg. What a week, Heidi. Happy Friday. I mean, we saw that roller coaster ride among markets and even SpaceX having 2 sessions of declines. It's interesting because despite all of this excitement, we saw that pressure on the company, but it's a company that continues to give us headlines, right? And we're now hearing that they're entering the credit market. Sources telling us the bankers are preparing investors, calls for a bond offering that could be at least $20 billion. The debt sale would refinance a temporary $20 billion bridge loan that matures in 2027. And this, of course, after the company received investment grade ratings from Moody's, Fitch, S&P. Moody's citing, for example, Starlink's strategic importance and SpaceX's government relationships. And this really playing into the broader story that AI funding, Heidi, is expanding beyond equity markets. And we know that Musk has utilized debt markets extensively in the past in his other businesses as well.
It's quite extraordinary because there is a sense that the epic fundraising campaign for this company has just begun. He's sort of made a lot of historical comparisons to the Union Pacific infrastructure project in California and how that was sort of thought upon as crazy at the time, but obviously proved people wrong. But if you take a look at modeling and what economists and financial analysts are expecting from SpaceX, they're saying that the company will spend more than $1 trillion by the end of the decade, the bulk of that focused on the AI operations and getting data centers to space. If you take a look at the share price, though, we have seen a little bit of to and fro, perhaps understandably, given how fast it had run up as well, ending the first week of trading 37% higher above that $135 price of this record IPO, despite, as you mentioned, Shery, that 2-day decline. So total market cap at close, $2.4 trillion, still making it the 6th largest company in the world, and also a point on eligibility for NASDAQ 100 index as well. 15 days of trading later, that could put more upward pressure on the share price because we'll start to see the demand coming through from passive investors as well. Well, Charles Schwab CEO Rick Wurster says SpaceX's stock market debut was one of the 5 busiest trading days in his company's 55-year history. He told us exclusively that retail investors are being drawn in because they can see and feel the innovation that the US tech sector is delivering.
And so you're seeing tremendous interest in AI-related names and the space names. I think it comes from the retail investor being able to touch and feel the level of innovation in our economy. And I think clearly they're holding names that are doing stocks that are doing well with really strong fundamentals. Exactly what the returns will be, only time will tell.
This was like a Super Bowl moment for financial markets, and we learned that there were war rooms. You set up various ones, and you increased your team. Can you just give us some color? Where were you during all of this? What was the vibes like in these war rooms that you set up?
It was a pretty amazing event in that it was one of the top 5 most active days for our clients in the 50-year plus history of the firm. And if you think about all the market events we've had over those 50 years, for the IPO to crack the top 5 is pretty unbelievable. We had 140,000 clients call in live. We had lots of digital engagement. It was impressive to see, and our teams were fully staffed, ready, and able to handle our clients' needs that day. It was wonderful to see the teamwork and the effort that went into making this a success on our side.
How do you think this is going to establish potentially what's next when it comes to other mega IPOs like Anthropic and OpenAI?
Hopefully it establishes retail having a really strong presence at the table. I think it's wonderful for the retail investor to be able to participate in something like this. So I hope this IPO establishes that. I think it also establishes an incredible level of interest among our client base for new and innovative technologies and being able to participate them. We recently closed a deal with Forge, which allows our clients to invest in pre-IPO companies. And so I think that the interest around these new ideas and emerging companies is quite high and will only continue.
Charles, Rick, the point that you just made is actually really important, given the fact that people note that increasingly the value is being created before the IPO when companies are still private. Do you think that some of these IPOs will expedite the efforts to get access to retail investors into private markets through a whole host of different ways?
I do think it will expedite it because people will have interest in getting in earlier because these companies are waiting far longer to go public. And so there's a lot of value being created while they're private and people want in.
Schwab President and CEO Rick Wurster speaking with Bloomberg Surveillance. We have more ahead on the Asia trade. This is Bloomberg.
The top global headlines that we're following this hour: in Indonesia has named capital markets veteran Jeffrey Hendrick as chief executive of its stock exchange as it tries to revive investor confidence in the world's worst performing market. The boss says Hendrick will take charge on June 29th for a 4-year term. He will need to address concerns raised by the MSCI, which has warned of a potential downgrade of Indonesia's market classification to frontier status. A bipartisan duo of senators has called on U.S. Treasury Secretary Scott Bessent to pressure China into addressing its exchange rate practices. Elizabeth Warren and Rick Scott told Bessent in a letter that the yuan is undervalued relative to economic fundamentals. They also called for labeling China an exchange rate manipulator in the Treasury's next foreign exchange report. Hong Kong is set to launch China government bond futures as Beijing seeks to promote global yuan usage and attract foreign capital. The Securities and Futures Commission is targeting the launch of 5-year CGB futures on August 3rd. It follows the expansion of onshore bond futures to qualified foreign institutional investors announced in April. Shery.
And Heidi, take a look at how currencies are trading. Of course, the Chinese market closed today. We also do have some other markets away on holidays, including Taiwan and Hong Kong. But take a look at the offshore yuan, because we continue to see that outperformance against the U.S. dollar, despite the fact that we do have that Fed rate repricing at the moment that has sent the U.S. dollar higher. The biggest 2-day rally that we haven't seen in about 3 months or so. Now, there's a difference with these capital inflows that we're seeing into the Chinese market when it comes to currencies. The Japanese yen, for example, now past that 161 level. We're talking about weakness that we haven't seen since 2024. So again, we're in intervention watch. Of course, in the Japanese market, we're also watching the tech trade. It's the same story with South Korea. Tech will be very important. The South Korea market, the Korean won continues to weaken against the U.S. dollar. That's whole Fed repricing hawkishness story ongoing in South Korea. But take a look at the equity space, because we continue to see the strength. We had the Kospi again rallying to record highs. In fact, past that 9,000 level. Of course, a lot to do with the biggest stocks in Korea on the Kospi: Samsung, SK Hynix, and the whole AI trade. Anything related to artificial intelligence, in fact, the fact that we had in the overnight session the Philadelphia Semiconductor Index reaching a record high, that will really prove more upside for these stocks potentially in today's session. As you can see here, the futures market already looking pretty positive. We had the broadening of the AI trade on the Wall Street session, the likes of not only semiconductors, but networking, storage, power, and infrastructure. So we'll be watching all of those stocks across the Asian session today. This is Bloomberg.
Take a look at what we're watching when it comes to this Friday fray for Asia. Of course, a little bit quieter with some of those holiday-thinned market volumes to be expected, but still a couple of key themes in focus. One, of course, will continue to be energy and oil, despite some of the longer-term or medium-term concerns over this US-Iran interim deal and the reopening of the Strait of Hormuz. We are seeing at the moment this reopening expected to really spark some optimism there. We have seen when it comes to the deep weekly loss for oil prices, that sort of of one to focus on, given that we have had the US Central Command lifting the blockade on traffic with the naval blockade as well. In terms of not seeing much of a move at the moment for the week, we are still seeing quite a significant decline. WTI towards that $75 a barrel level, that contract tumbling by more than 9% this week alone. The Nikkei 225 looking into the start of trading up by 0.8%, also seeing quite a pop expected for the Kospi as the AI and tech related trade continues to play out. Bit of volatility for SpaceX shares, but still 37% higher from the IPO price. We're also seeing more fundraising as well from SpaceX. So lots still happening when it comes to the tech space, Shery.
And Heidi, we do have breaking news out of Japan at the moment. We are getting the national CPI year-on-year growth of 1.5%, coming in line with expectations, a slight acceleration from the previous month. When it comes to the core CPI number, exclude fresh food, and you get gains of 1.4% in line with expectations. Now, exclude energy as well. You get core CPI and its growth of 1.8%, a slight deceleration from the previous month. Of course, we were expecting a little bit more upside when it came to broad inflation numbers, given that we have seen the rollback of energy subsidies here in Japan, also higher fresh food prices. We continue to watch, of course, the wage growth, especially in real terms in Japan, for what could prompt the Bank of Japan to continue normalizing policy and hike rates. Now, inflation, of course, potentially could ease with this agreement that we have now between the U.S. and Iran. An impending wave of oil is said to be unleashed on Asia. Around 31 supertankers that were stuck inside the Persian Gulf are now set to sail out as the waterway opens up. Let's bring in Jessie, Moritz, a senior lecturer in political economy at the ANU Center for Arab and Islamic Studies. Jessie, really good to have you with us. Of course, we heard from Vice President J.D. Vance not necessarily being very clear about what happens to these tolls around the Strait of Hormuz. What are the risks that this might actually just transform into service charges or other types of fees for the waterway?
Yeah, I'd assess that risk as relatively high, actually, because the deal only allows for 6 months or so of toll-free or fee-free passage. And the Iranians have already been very clear that they intend to continue negotiating with Oman over control of the Strait of Hormuz, not necessarily not to allow ships in out, but to try to charge, they're calling it sort of a service fee, if you like. And so they're trying to navigate around international maritime law and to find a way in which they can continue to exert authority over the strait. And that would be a major strategic win for Iran out of this conflict.
Exactly. I was going to say, what exactly has Washington gotten out of it if we are seeing, of course, potential losses on the Strait of Hormuz side of things, not to mention, of course, no real clarity on a nuclear deal or even what's happening with Lebanon at this point?
Yeah, so it's very clear that this is a deal to avert immediate economic crisis. Trump was very clear about that in some comments recently, that this was something he felt was necessary to deal with the fact that our strategic petroleum reserves have been declining at a very rapid pace, and that when they do hit a sort of minimum operating floor, for example, that's a serious issue for the global economy. And so he was trying to avert that. And the Iranians, of course, they know that the US is always going to be more responsive due to its power as the largest economy in the world and sort of the world's superpower. It's going to be more responsive to the concerns of the global economy, whereas Iran could withhold a little bit longer. Trump, of course, is also a democratically elected president, and he's looking down the line at midterms, and he's looking at the impacts on the Republican Party and his personal popularity. And then there's internal factionalism within the MAGA movement between himself and potentially J.D. Vance around this conflict. So for various reasons, largely to do with the fact that the US is a democracy, they were more likely to be under pressure to end this conflict, even if this deal is not particularly durable. And you've raised Lebanon and the nuclear issue as two issues that could still yet see this ceasefire deal collapse.
It's interesting, we heard from President Trump speaking to Axios earlier refuting the idea that these negotiations, the way that the war has been carried out, has kind of shown him the limitations of his power, right? he is getting a lot of pressure domestically. How much pressure do you think he's also getting from allies, particularly when it comes to the collateral damage that's been suffered by Gulf states in a war that they didn't have any part of and didn't start?
Absolutely. Enormous pressure. And not just from the Gulf states, but from every state that's dependent on transiting supply, whether it's oil and gas or it's aluminium or fertilizers or anything else coming through that strait. They were pushing for Trump to find a way out of this conflict. You know, the strategic challenge of this conflict was always going to be that Iran did have the capacity to hold the strait. And it has caused economic challenges for Iran. It's not great for them to not be able to get their own oil and gas out, at least through the strait, putting aside Central Asia sort of land routes. But they were always in this position to be able to hold the strait for longer than the US was going to be able to tolerate the strait being closed. So the fact that Trump, in a number of comments, admitted that they didn't have a plan or that they didn't have a strategy for dealing with the closure of the Strait of Hormuz is a major strategic error, I would say. And the interesting thing that's happened with the GCC states in particular has been some disunity within them around how to respond to this conflict. So the UAE, for example, has been hit with some of the largest drone and missile barrages during this conflict, and they have wanted and have pushed for a more aggressive response from both the US and from international partners to sort of retake and re-seize the Strait of Hormuz, whereas states like Saudi Arabia and Qatar and Oman and others have been looking for a negotiated end to the conflict. And so you're starting to see that negotiation, particularly through the Qataris and Omanis as well, bear some fruit with this ceasefire deal. But we should expect to see some disunity amongst the Gulf states in the next couple of years out of this conflict.
What happens from the Iranian side? Obviously, there's been damage, particularly when it comes to the upper echelons of its leadership. Does this take us actually further away from the prospect of regime change and of Iran becoming a more responsible international player, particularly if the sort of initial maximalist demands on the nuclear program are now watered down to the point where the stockpiles are still buried, their nuclear enrichment knowledge is still intact, and arguably perhaps they have more reason than ever to believe that they do need to hold on to their nuclear program?
Yeah, I mean, we're in the early days of this deal, and much will depend on what type of actual action we see from Iran in order to get more of their cash released and sanctions lifted in the longer term. We will see this go into longer term negotiations, depending on what happens in Lebanon. But internally within Iran, unfortunately, much of this conflict has empowered hardliners rather than caused the type of destabilization that you might expect to see ahead of regime collapse. And both Israel and the US were very clear, at least in early stages, that they did want to see the Iranian regime collapse. One of the challenges when you take a country to war like this and it doesn't, the regime survives, is that the regime is then very incentivized to crack down in a very violent and repressive way on domestic political opponents. They'll use the excuse of the conflict to do that. And I'm very concerned that that's what we might see in Iran in the next coming months, is a crackdown on domestic opposition, which is the exact opposite of what the US interest in this conflict would be.
How big of a shift was it that Iran's supreme leader accepted direct talks with Washington? And does this give us any indication of how the negotiations could go from here?
There is, of course, this new disunity that's been created within the Iranian regime between sort of not just the traditional hardliner and reformist camps, but also between those who are more connected to the IRGC and have been directing the military response to this conflict, and those who lead the civilian political apparatus, including those who are directly involved in the negotiations. So to see the supreme leader more directly involved suggests that they are attempting to bridge that disunity and ensure that everyone's on the same page, because the previous ceasefire deal that we had, of course, was so fragile, largely because immediately there had been protests within Iran from hardliners or those aligned with the sort of IRGC factions against the ceasefire deal. That disunity seems to be a little bit reduced this time. It's still there. It's still very present. But there seem to be some attempts from inside the Iranian regime to bridge those divides and ensure that they have one clear negotiating position with the US, especially because they're best outcome here is to get as much of their own oil and gas out through the strait while the strait is open, in case, for example, the ceasefire deal collapses again over Lebanon, particularly as the Israeli government and Ben Gvir and Smotrich in particular have been very clear that they don't see why Israel should be held to the terms of this deal, and they've continued firing in Lebanon.
Jessie, Moritz, really good to have you with us, senior lecturer at ANU. We have more ahead on the Asia trade. This is Bloomberg.
Australia's government is expected to announce changes to its proposed capital gains tax reforms today after facing criticism about the impact on startups and small business. Bloomberg's Paul Allen joins us now for more. So what are we expecting to hear?
Well, a lot of it's been signalled in advance. Anthony Albanese, Jim Chalmers out yesterday with a sort of a preemptive statement, if you like, that capital gains tax discount, it will be able to continue to be accessed by businesses with turnover of under 10 million or $7 million US. But they're going to need amendments to the existing legislation, so we have a Senate hearing. The government does not have a majority in the Senate, so it'll need the support of the Greens to get this through. But it all stems back to concerns from one of the headline acts from the budget, which was changes to the tax system and the removal of this 50% discount on a capital gain. Now, the intention was to calm down the housing market, but there were multiple warnings of unintended consequences from state and territory governments, commerce commissions, the Tech Council of Australia, venture capitalists, just this long list of people. And the Australian Investment Council had some telling testimony to the Senate, saying some of these heroes of Australian entrepreneurship, like Canva, like Employment Hero, would not exist without the current tax settings. So the hearing today, the announcement today, that's an attempt to undo some of the damage here.
Is it a win for the swell of public opinion?
It's inviting to sort of arrive at that conclusion, isn't it? Particularly when we have a situation, as we were discussing earlier this week, where One Nation, now the most popular party on the primary vote, Pauline Hanson, scarcely believable 3 decades ago, now preferred Prime Minister as well. And, One Nation's running this campaign, Fire the Liar, of course, referencing to Anthony Albanese and the broken promises from the election campaign. The government's framing it differently. They are saying we came to a different view, but it's hard to escape this framing that they've been in some way dishonest, should have consulted first, and now they're in a situation where they're backpedaling. So on the one hand, the government was making these changes to help get young people into homes, but on the other hand, they've ended up being accused of crushing the aspiration of that same demographic.
Thanks, Paul Allen there. Sticking with Australia, and KPMG Australia is set for a public reckoning. A hearing is currently underway this morning in Parliament over allegations of misusing confidential client information to win contracts. For more, let's bring our finance editor, Adam Haig. So, Adam, give us a background as to what we're contending with here.
Yeah, really everything that we're going to be hearing in Parliament today focuses on the allegations that were made public in March around what KPMG staff did with some investigation that they'd had into some whistleblower allegations. Now, it centres on kind of Lendlease, who are a customer of KPMG and their audit division. The allegations are around whether that information that KPMG had made its way into other bid pitches for other companies and for other business. And really what the parliamentary hearing is trying to do today is trying to ask questions of both current and former staff at KPMG, but also a swathe of other people, including the regulatory bodies that are involved in this, to try and get more information on the public record about what's happened. There's obviously a big kind of push from the KPMG side to keep some information private, which is obviously well within their rights to do so. But the hearing almost treads this fine line between kind of what these parliamentarians can tease out of some of these key witnesses and what will still need to remain confidential, given that there are investigations that continue into this matter.
Have we seen an impact on the business?
Yeah, I mean, obviously, the initial kind of fallout is already played out, relatively well, and KPMG came to an agreement earlier this week with the government to not bid for any new work at least through to September. So clearly, it's impacting future revenues there, but it's more about the brand, isn't it? It's more about the sense of how this tarnishes the brand, because at this stage, nothing's kind of been proven one way or another, and we're still at the stage of allegations. So it's a very, in many ways, early stage process here where the parliamentarians allow quite serious questioning around what's happened. But they need to get more on the public record, and that's really what today's all about.
Finance editor Adam Haig there. We do have more ahead. Here to come on the Asia Trade, this is Bloomberg.
Take a look at how we're setting up for the Japanese market opens in less than 12 minutes at this point. Take a look at the Japanese yen. We're on intervention watch again. We're at the weakest level since July of 2024 against the greenback. We have seen really the downside on the Japanese currency, given, of course, the Fed re-rating, the U.S. repricing, widening the policy gap. That has become a Japan story now. We continue to watch JGBs under pressure. Could we see flows back into Japanese bonds with lower energy price risks, perhaps? But it's right now the USD JPY story remaining dominant in the rate outlook. And take a look at Nikkei futures pointing to more upside. We had already seen 6 sessions of gains. We're already at the highest on record. This is the longest winning streak since August. So we're seeing really that dichotomy when it comes to flows into the Japanese markets. And of course, one sector that we're watching is always going to be semiconductors here in Japan. And materials giant Resonac now saying that it's seeing very strong demand for AI, helping its clients, including TSMC, Tokyo Electron, and NXP. But speaking exclusively at the Bloomberg Look Ahead event in Tokyo, CEO Hidehito Takahashi also acknowledged risks associated with trade involving China and Taiwan.
I think everybody is very excited about this huge AI demand throughout AI value chain, because now you'll see AI agents, going everywhere. And then the next step is probably physical AI. And if that comes, robotics and, edge device and also a mobilities all require AI semiconductors. So I think people are playing in this field are very bullish about the demand going forward.
Where are the choke points? What's the reasoning behind, especially if we get a settlement on the Middle East conflict?
We still have copper laminates uses copper. So, and metals price also increases. So, now everything, price is going up. So, we just would like to make sure. Also, electricity is expensive these days. And I think after this July or August, all the electric company will increase the, price.
When it comes to how your business positions from here, what are some of the bright spots then?
Bright spot? Of course, the increasing demand for it's very strong. You feel it, the forecast is upward adjusted every day, basically. So it's AI demand is very, very strong.
When it comes to China, for example, you recently increased production capacity there. At what point do you make a decision on another round of investments?
I think it depends on the demand in China. What we are doing is, of course, Chinese local semiconductor players are growing, will grow definitely. So we would like to take advantage of that growth. And our strategy in China is procure in China, produce in China, and sell in China. So that I'm seeing China as a block. I don't want to trade because there will be a risk of supply chain.
Producing in China, does it entail risks, especially around IP?
We are mainly producing relatively commoditized products in China because cutting edge is not still there, meaning, that their AI technology compared with US AI technology, they're still behind. So we don't really need the cutting edge materials yet.
And we continue to see these export controls between China and the West.
Right.
Doesn't that give you a headache as a CEO of a major company?
even though I'm optimistic, I'm thinking about that. And of course, I'm seeing China is one block, Japan and US and Korea as another block. So hopefully Taiwan joins that, but we still have some risk in Taiwan, so we have to think a little separately. So these three blocks, we try to separate as much as possible, meaning I would like to make in China and sell in China. And Japan and Korea and US, I'm okay with trading.
What are the risks in Taiwan?
Risks in Taiwan, we don't know what China will do, so we have to think about that.
So you're trying to diversify your client base, your
but TSMC is so big, you have to be in Taiwan. So we are in Taiwan, but we have risk management process if something happens.
Resonac President and CEO Hidehito Takahashi speaking to us exclusively here at the Bloomberg Look Ahead event in Tokyo. Take a look at some of the stocks that we're watching. Of course, is really about the chip supply chain, isn't it? And one of those stocks that we'll be watching in today's session, for example, Tokyo Electron, it's an Intel supplier, and Intel just surged in the overnight session after President Trump said Apple would work with Intel to design and manufacture chips domestically. We're seeing the upside at the last close. But of course, it's also the likes of Ibiden, for example. Do keep an eye on that stock. It gets 20% of revenue from Intel. And of course, Heidi, we had that huge upside in Philadelphia Semiconductor Index overnight, which reached a record high.
Yeah, Shery, we're watching BHP on the news that the company is taking a $2.3 billion write-down on its giant Jansen potash mine. This has been problematic. It led us in a series of cost and time overruns for the expansion of the project, which is in Canada. We've seen this sort of routine blowing past of cost estimates for this controversial project. We're now seeing that cost of $6.9 billion, up from an earlier forecast of $4.9 billion. And as BMO Capital Markets points out, the updated capex guidance is 13% more than their estimate, up 41% from a previous guidance. So this has really become unanchored when it comes to market expectations, Shery.
And of course, we're watching the Japanese yen headed towards the market opens here as we're getting the latest Bank of Japan minutes from their April meeting, where they're considering the pace of adjustments by watching the Middle East impact. Of course, they hiked rates already this month. This is Bloomberg. We're counting down to Asia's market opens. Some markets away on holidays today, Heidi, including mainland China, Hong Kong, and Taiwan. But the markets that are open are dealing with another day of huge gains for the tech sector and, of course, implementation risks around the Iran truce.
It is really that risk that you point to, right, given that we don't know what will happen beyond those 60 days. There's a fair amount of criticism and concern that we could see tolls being charged on the Strait of Hormuz after that period, which perhaps, Shery, is why we're seeing a pretty muted reaction for oil markets right now.
Yeah, take a look at how Japan is coming online, because we had seen, of course, the repricing of energy stocks and the oil trade as well in the Japanese session. Today, we're watching the repricing, of course, the Fed rate hike risks. The Japanese yen continues to be under pressure. We're talking about levels that we haven't seen since July of 2024. So we're very much on intervention watch. The Nikkei opening higher 0.7%. We had seen immense gains for the Japanese market. If we finish higher again today, 7 sessions of consecutive gains and a record high, and we haven't seen this number of gains consecutively since August of last year. We're watching the JGB space as well, because we had downside pressure. Of course, as I mentioned, Fed rate repricing is still the major story here across Japan, as well as, of course, the tech story. So do watch out for names like Tokyo Electron, Ibiden. We heard from President Trump that Intel will be working with Apple to make chips domestically. So that would be a huge story, not only for those suppliers here in Japan, but of course also across South Korea Korea and that tech AI trade in the Kospi. Of course, Samsung, SK Hynix are the ones to watch, while the Korean won continues to see weakness, a little bit of strength today, but we're talking about mid-1500 levels, which is really making South Korea the worst performing currency across Asia. The Kospi, though, continues to gain. We're talking about a record high already as we continue to watch the tech trade, which these two biggest stocks on the Kospi continuing to gain ground, Heidi.
Shery, take a look at the sort of continuation of the repricing of bond markets, particularly Treasury markets, in the wake of Kevin Walsh's seen as hawkish start of the Fed Reserve, really forcing that rethink across the broader market. We've seen long-dated bonds being rewarded, wrong-footing investors in parts of the market who had expected perhaps a more politically pliant or dovish central bank under his watch, which we haven't sort of gotten that so far anyway. So there is this expectation that shorter-dated Treasuries have more room to adjust. Longer maturities still could see more benefit if we see a tougher inflation stance from the Fed. So that's the sort of contention that we're seeing here. We're seeing PGIM forecasting further flattening of the yield curve as well. Doesn't actually even rule out an inversion there. If you take a look at what we're watching with oil markets, as I said, not a great deal of big movement. Brent crude coming online, we're seeing off by about a 1%, still about a 9% decline if you zoom out to the weekly look for WTI. So at the moment, a little bit of a holding pattern as we wait to see, as Shery mentioned, some of those implementation risks. What happens if we are faced with that reality that perhaps Iran will charge tolls or surcharges of some kind for vessels passing through to the now reopened Strait of Hormuz? Here in Australia, we're seeing downside of 1%. Watching BHP as that heavyweight is likely to come under some pressure with another cost upgrade when it comes to the controversial Jansen Potash project, higher than expected, $6.9 billion, and that $2.3 billion charge there in play as well. Aussie shares broadly, we did see that 4-day rally, so a little bit of a pullback now. Let's get some more market analysis with Isaac Poole, who's the CEO of Ascalon Capital. Isaac, really great to have you with us. So obviously a lot of cross currents in terms of what markets are watching, and we didn't even get to the tech piece, right, which continues to accelerate. What's compelling for you right now?
I think the point that you made around bond yields, government bond yields, US Treasuries, pushing higher at the short end, but interestingly flattening after some relatively hawkish commentary coming out of the Fed yesterday. This is an area that I think is starting to look very interesting, and has been interesting as US 10-year Treasuries have been up well above 4%. These are levels that historically are pretty good return periods for Treasuries. So, we think focusing in on fixed income, picking a little bit more duration up in the curve could be really beneficial for investors looking out over the next 6 months or so.
So are you at this point in the camp that the Fed is done when it comes to easing?
I think they are. I think there's been some nice tough talk there from new Fed Chair Walsh, and I suspect that the intention was to try and jawbone the longer end of the curve lower. But we have a peace deal in place. Inflation is likely to trend lower over the back end of this year. And while the unemployment rate has been relatively low, I think when you look underneath the numbers, there's a little bit of weakness there. So I think there is no real intention to hike rates further from here. Doesn't mean we get a rate cut over the course of this year. I think we're going to see that policy rate remain about where it is for the rest of this year.
So if we stay status quo right now, what does that mean for Asian markets? We have seen, of course, the support in the U.S. dollar, the repricing of risk around the Strait of Hormuz. What will be the biggest driver here?
I think across Asia, the fact that the US dollar is strengthening is not great news, but on the other side, you have longer dated yields moving lower. You have oil prices well and truly off their peaks. That is an environment that historically has been quite good for Asian equities. So we look across that space and think that both on a relative valuation, but also an absolute fundamental perspective, Asian equities could perform relatively well here, and given some of the challenges that are racing across Europe in terms of the economic growth looking a little bit more painful and inflation perhaps being more sticky there, it's not a bad place to be.
Isaac, on your point on lower Asian yields, is the Japanese JGB market a whole different story? Because, of course, we do have the Bank of Japan doing its own thing, the fiscal concerns around the Takahashi administration, but, of course, the dollar-yen being also a dominant story here when it comes to the rate outlook.
100%. The Bank of Japan doing its own thing is a good way of putting it. It's always done its own thing, and I would say historically has done that poorly. It tends to be late to the party. It tends to wait too long to hike, and we saw the impact of having rates at a very low level for many decades. The Bank of Japan should have been hiking last year faster. Now it's hiked once. Just, I think, as inflation is impacting it and growth is likely to slow, further hikes, I think, will be particularly painful for Japan's economy. And I think it does call a little bit into question the durability of the rally that you're seeing in equity markets. And I think despite the attempts to hike rates to shore up the currency, I think that will be a challenge for them. So, look, we're not particularly positive on Japan at the moment. I think it's going to face challenges, and the Bank of Japan, if it hikes again, will likely cause a lot of pain in its own economy.
In fact, the deputy governor of the Bank of Japan, Ryozo Himino, speaking right now in Parliament, saying that they need to watch the impact of currency on the economy. They expect the price trend to rise gradually, that there's a risk for price trend to rise above the 2% target, and to keep raising rates in response to the economy and also to the price trend in Japan. But Isaac, when it comes to the equity space, though, there has been a lot of optimism around reform, around the changing governance, around earnings also staying strong, given that a lot of companies also benefit from a weaker Japanese yen. When you're not that positive about Japan, does that include every sector in the equity space as well?
No, I think when you look at Japan, you do have to separate out the structural impacts from the governance improvements that are real. They're coming through, but I would argue that that's been largely priced in well and truly to the equity markets from here. But it's an important shift. It does push up the longer term fair value and perhaps help the valuations that we see be a little bit more justified over the long run. It's the cyclical side that I worry about, and really the lateness of moving policy higher, just as inflation is sticky and hurting the economy. And I think the broader economic story is likely to slow down. So, structurally, yes, some really great changes that we've seen not just over the last few years, but the last decade. Cyclically, I think it's probably not being priced in some of the downside risks.
Isaac, we talked about opportunities looking interesting for treasuries. Are they more interesting at this point when it comes to Australian bonds, particularly since we've seen that sort of repricing since the May 5th pause, right? Do you have expectations that there'll have to be easing to come perhaps in the next couple of years, and does that create the opportunity?
It does. I think that there'll be easing potentially at the back end of this year or early next year. The underlying economy in Australia is facing some challenges. And so the RBA, while it's talkish, I think they are closer to cuts than they are to material hikes. And that does make Australian government bonds really attractive. I mean, if we go back a couple of months, the Australian 10 yield up around 5.25%, there's a whole generation of traders and analysts who've not seen that in their working career. That was a real opportunity to add some duration. And while we've seen the yields move lower from their peaks, there is still a lot of scope for yields to push down towards something below 5%, and that delivers some real upside for people who have been willing to take that duration risk.
Isaac Poole, really good to have you back, CIO of Ascalon Capital. We continue to watch the tech sector across Asia. Of course, we have seen that big upside in the overnight session with the AI trade just broadening out. It's not just about semiconductors, it's networking, storage, power, infrastructure, and we're seeing the broad upside in the Asian session as well, with Samsung Electronics gaining more than 7%. But it's really about the Samsung Electronics chips trade, the SK Hynix chips trade of almost 6% right there. We had also heard overnight that President Trump said Apple would work with Intel to design and manufacture chips domestically, so do watch out for those Apple suppliers, Intel suppliers as well.
Yeah, check in on BHP is what we're watching here in Australia with that $2.3 billion potash project charge. Costs, again, being outrun. And this has sort of been a continuing theme when it comes to the routine series of cost and time overruns for the expansion of this project in Canada. This has blown past cost estimates many times. Now, following the latest review, I should say that phase 2 expansion will now cost $6.9 billion. The earlier forecast was $4.9 billion, with production to start at the end of 2031. We're seeing quite a bit of downside there as these investor expectations continue to become unanchored from the reality. Those initial expectations were between $1 and $1.5 billion for the upwards revision. So clearly what we're seeing is beyond that, and the likes of BMO Capital Markets saying that guidance, more than estimate, their own estimate, more than 30% higher, up 41% from a previous guidance as well. But on the upside, no further delays or updated cost guidance broadly expected. More ahead on the Asia trade. This is Bloomberg. Some breaking news crossing the Bloomberg. China set to impose additional tariffs on Australian beef from June 20th. An additional 55% tariff will be implemented on Australian beef imports. Beijing saying that Australia beef imports hit the 100% of the quota on June 18th, so that 55% tariff will kick in from June 20th. This has been sort of long flagged and expected for the red meat industry here as well. They are expecting, in terms of the impact, that strong beef demand that we've seen from the US market, Southeast Asia, will likely offset the impact of this new tariff from China. But that new quota system had been announced by the Chinese government, and it was expected to result in that 55% tariff if the quota was exceeded. Analysts had been saying early to mid-June would be when that cap would be hit. But that diversification of the export base will certainly help Australian producers at this point in time. In the meantime, we are seeing an improvement when it comes to the outlook for energy and for some of the, of course, energy-adjacent industries that have been depending on the reopening of the Strait of Hormuz. We're seeing shipping beginning to return through the strait, the US lifting its naval blockade as part of the interim peace deal with Iran. Lots of concerns, though, remain about whether Tehran might eventually charge fees on vessels. Vice President J.D. Vance skirted questions about potential tolls in the strait after the 60-day negotiating period ends.
That's not about tolling. That's about ensuring that the straits are never used as a choke point for the global economy ever again. It's frankly not what the Iranians want. It's not what the Omanis want. It's not what the GCC wants either. So what we're going to do, of course, working with our allies in the region, is to ensure that that is reflected in the final deal. And if that's not reflected in the final deal, there's not going to be a final deal.
Let's bring up Bloomberg editor Michael Heath. So the clock has started on the 60 days. A lot could happen.
It could, Heidi, and it's quite difficult to sort of get to the bottom of what JD Vance is saying there, because the memorandum of understanding basically says that there will be no tolls for 60 days, and then as he says, Iran and Oman would sort of look at a regime there. What he seems to be talking about is that there'll be some sort of new architecture for what goes on in how the straits are used, etc. But in a sense that it doesn't make any difference. I mean, Iran can shut the straits anytime it wants. We've now seen that. And the likelihood seems to be, and there have been Iran figures quoted as saying this, that they'll impose some sort of services charges on boats going through, on vessels going through to make some money out of it. And I'm not sure there's a lot that can be done about that unless we, want to go back to conflict or something. And the US has sort of made it clear now that the bigger picture is the, nuclear issue, ensuring Iran doesn't have a nuclear weapon and that it's enhanced enriched uranium is removed. So, J.D. Vance went on to say that the main issue is that the strait is open, which is good for the world economy. But yes, as you say, there's still a lot to go on.
The Axios show interview with President Trump was really interesting, right? He refuted this idea that this whole process has shown him the limitations of his own power. He's insisting that, this is probably going to be unconditional surrender from Iran, that they had defeated them completely militarily. At the same time, though, he acknowledged the economic pressures in terms of not being able to get oil supply and the such. Though we always see this part of the president where his ability to kind of turn one thing into what he sees as reality is quite remarkable.
It is extraordinary, isn't it? And we had that, yesterday or the day before, where he suddenly was switching to talking economics and depression and that sort of thing, and how significant it was that this had been avoided, even though he was the one who'd brought it on in the first place. So, look, he is a master communicator. There's no question about that. There's quite a lot of funny stuff going on social media when talking about, Iran, the unconditional surrender, that in fact it was the US that had unconditionally surrendered here. But nonetheless, I think we have seen the limitations of their power. And you spoke to Dennis Richardson, a sort of former doyen of the Australian foreign policy community, where he said that the US could win militarily and lose strategically, and they wanted to win strategically. And I think we're really seeing this question coming into light now, how that will actually work out. No doubt they won militarily, that's no question, but we're dealing with bigger issues now than that, and Iran has put itself in a much stronger position than anyone anticipated, I think.
Bloomberg editor Michael Heath there. Let's actually take a look at the forecast for oil markets, given what's happening around the Iran truce, around the Strait of Hormuz. Let's bring in Stephen Sapchinsky, who leads our Asia energy coverage. And Stephen, Michael's just telling us how strategically in a good place Iran has put itself. It could even ramp up oil production faster than others had expected. What are we seeing on the ground when it comes to really this flow of oil from the Gulf?
Yeah, I mean, we're seeing right now a bit of a wave of supply. So there are a lot of tankers that have been stuck in the Persian Gulf for months. They've been loaded with oil, and you're starting to see some of those exit. 3 super tankers that were Saudi Arabian owned, those have exited. UAE vessel has also left. And we've also actually seen, as you mentioned, Iranian vessels also going through the Strait of Hormuz with their ship tracking on, with their AIS transponders on, which means that they're not trying to hide their location, further illustrating that the strait is indeed opening. Now, I think the big key thing to watch is how many empty ships return, because what I'm talking about here is a wave of supply that had already been essentially waiting to get out. Now, the big thing is, will they be able to sustain this? Because once these ships empty out, you need the ships that are no longer holding any oil or gas, the laden vessels, or rather the blast vessels, to come in and then pick up the oil or other products. And if Iran is able to really ramp up, this will be an interesting development in the market because it will add even further supply. For years, Iranian oil has been sanctioned, but part of this ceasefire and MOU that was signed between the U.S. and Iran stipulates that they will provide waivers for sanctioned oil. So basically, folks who want to buy the oil would be able to get around the sanctions, and also the U.S. supposed to move towards removing sanctions against that oil. That could unlock a lot of more supply into the market. They produce 1 to 2 million barrels per day. That's a couple % of global supply. So it does certainly bode well for the Iranian regime.
Goldman Sachs now saying the Persian Gulf exports should normalize by the end of July instead of their initial call of the end of August. If that's the case, how much have markets actually priced all of this in, with Brent now below $80?
I think oil probably still has some way to go if you want to truly price in the Strait of Hormuz opening fully, and for trade from that region stabilizing. I think the most important thing, that being that we're supposed to be in a glut year. Before the war began, there was talk about an oversupply for oil. U.S. oil exports and production had been ramping up. OPEC Plus have been adding barrels to the market. Chinese demand has been weaker than a lot of people expected, and even over the last few months, Chinese imports have really crashed. If that stays up, if Chinese demand stays lower, you see the normalization of trade, you have the U.S. continuing to at least produce and export to some degree, then you will have a frothier market, and you could see more downside for both Brent and WTI, the two main oil benchmarks.
Stephen Sapchinsky there, who leads our Asia energy coverage. And we do have an alert on the Bloomberg. The U.S. has started a Section 301 probe of Germany over pharmaceutical products. Now, we have, of course, seen a Section 301 investigation that could eventually lead to tariffs. A USTR now saying that the investigation of Germany's underpayment for pharma is underway. We have seen the Trump administration making waves of pharmaceutical pricing, arguing the foreign governments suppressed drug prices, forcing U.S. consumers to subsidize global pharmaceutical R&D. Now the U.S. calling on Germany to pay for their share for innovative products. We have more ahead. This is Bloomberg.
Well, votes are being counted in a crucial UK by-election that could shape the political fate of Prime Minister Keir Starmer. Let's get the latest with our Bloomberg correspondent, Rosalind Matheson. So talk us through these results that we're expecting and how it could really kind of change the path forward when it comes to this leader and this government.
Well, this is one of the more consequential UK by-elections we've seen in many years. As you were saying, this is Andy Burnham's potential path to the Labor leadership and with it the job of Prime Minister in the UK. So he's standing to get a seat in Parliament in order to challenge Keir Starmer for Prime Minister. So he needs to win this seat. Most polls show that he will, although the Reform UK, the far-right party, has been mounting a significant challenge in this seat. And of course, they did pretty well in the recent local elections we saw across the UK just a month or so ago. And so Burnham really needs to win this seat and win it quite convincingly to say that he's the one that can lead Labor into a next election as leader.
Exactly. So how much is this election about Burnham versus Reform UK as much as Burnham versus Starmer, especially when it comes to winning back some of those working class voters?
Well, certainly he needs to position himself as the leader of Labor who could do that because Reform's been making inroads in those local elections. Labor came to power with a really strong victory in 2024, but the popularity of this government has plummeted since. Some unpopular policy decisions, fenced in fiscally. They can't really do very much on the reform front with their own policies. And of course, the brouhaha over Starmer's support for Peter Mandelson as the ambassador to the US, embroiled in the Epstein controversy. So all those things have chipped away at Labor. So it'd be a big ask for Burnham to show that he could be the leader again that could defeat Reform into the next election.
Right. Our chief Asia correspondent, Rosalind Matheson, there as we follow, of course, those elections in the UK. More ahead. This is Bloomberg.
Take a look at what we're watching as we've, of course, got Greater China markets, Taiwan as well, off for a holiday today. So a bit of sort of holiday volumes we're looking at, but still to the upside, the Nikkei 225 putting on about 0.7%. We're seeing that resurgence of the chip trade continuing to push the Kospi higher in this session as well. Australia off by just about 1%. We had news of those China beef tariffs with the cap being reached for the quota system, and that will kick in on June 20th. Still, we shouldn't see too much of an impact when it comes to these agri names, given that we're expecting the demand from the American market, Southeast Asian market should be able to counterweight that diminished demand from China. We are watching rare earth stocks and companies in particular. Obviously, Lynas is the main one trading in Australia. But when it comes to some of the Chinese names, we've also seen that rally in the previous session after G7 countries agreed to limit their reliance on any single supplier of the critical mineral. So let's bring our next guest, who says that G7 rare earths target is strategically significant. With us now is Marina Zhang, who's the Associate Professor at the University of Technology, Sydney. Strategically significant, and I think most people would say sort of the right idea, certainly. There's no pathway to implementation and how they can practically make this happen, though.
Well, it is strategically very significant, but realistically, it's far away from reaching near free China supply chain resilience in the short term.
Is there any clarity on how that target can be met?
Well, I mean, the value of this declaration is really it's legitimized the sort of industrial policy that has until more recently it's been taken as very much interventionist, to be legitimate to used collectively by G7 and allies. So China will not take this very lightly, and China can use it as an excuse that can retaliate again.
What could you expect in terms of further use of export restrictions and the impact that would have on the broader market if Beijing were to retaliate, or at least to fire a warning shot?
Well, I mean, it's quite clear from the declaration that the G7 has now realized that the borderline, the battle line is not just on mining. Actually, is gradually shifted to the ecosystem of mining, or you say the global value chain of mining. That includes from chemical used to treat minerals, to mineral productions, to processing, recycling, waste management, and standards. So China has quite strong dominance in all this ecosystem. So for the West, this collective action will certainly accelerate their decoupling pace, but it's a very long battle, and China has more and more realized its value, its control is not just in mining and process, and is even you can even trace even further upstream. That is, for example, China has been using the not so glamorous element, sulfuric acid. China has recently announced is on the list of export ban. So this will not only just have impact on fertilizer production, but also for mineral treatment, because a lot of minerals, I mean copper, lithium, and so on, all rely on sulfuric acid to treat before it can be used. So that's China's advantage.
To your point on how long this decoupling takes, I worked in Tokyo back in 2010 when China banned critical minerals exports to Japan. Throughout the whole time, Japan has tried to diversify away from China. I come back here to Japan 15 years later, and this is still the top story. Is Japan a reflection of how difficult it is to move away from Beijing when it comes to these very critical minerals? And what can you take away as a lesson from the Japanese experience?
Well, that's really a great example. I mean, Japan is perhaps the most stress test case of China's critical minerals, you call it coercion or ban or whatever. So after 10 years, I mean, more than 10 years, 15 years, as you said, Japan is still, I mean, perhaps just moved a little bit more on reducing China's dependence on light rare earths, but in terms of heavy rare earth elements, despite the effort, for example, in investing in liners and promise to buy offtake products from Linus Malaysia and so on, and stockpiling, not forget about that. Japan is almost at the critical point of shortage of heavy rare earth elements in recent months. So that is exactly the point that, I mean, to build a China-free supply chain will take longer than any projections on paper.
Marina, talking about really the decoupling and the divergence among regions, I was speaking to the CEO of Resonac last night, and he was telling me how he does business in these blocks, whether it's manufacturing in China, selling in China, doing business in the US, in Europe. He saw the world in these three distinct regions. Is this the future for semiconductors, for materials, for artificial intelligence, and what's the implication of the next generation of tech given this really divergent regions?
Well, I mean, that's a very good question. For global supply chains, I mean, we are having a very clear indication that we shift the logic from free trade now to a security first logic. So that means, well, I mean, national security equals resource security. But most countries, they have increasingly realized that, well, resources are so important. So they have started implementing resource nationalism. I mean, countries in the global south, they all want to move up the global value chain. But we often forget how complicated, how interdependent the global production network is. I mean, that reaches not just, in the mineral processing sector, but also downstream magnet production and EV production and semiconductor production. It is entirely a very sort of a interdependent global production network. To clearly decoupling the system into, doesn't matter is block or regional based spaces, is not going to be easy. So that's just the reality we're facing.
Marina, there's an obvious opportunity for Australia, right, as one of the few places that could benefit from this attempt to break up the dominance of China. Do you think the industry, in terms of the ability to process and to look at the whole of supply chain rather than just operating, as a quarry essentially for some of these critical minerals, do you think Australia is in position to be able to benefit?
Australia definitely will benefit from the industry policies from Australian domestically and also indirectly from the U.S. Industry policy subsidies. So basically, we're in the age of that. We're using sort of price floors for critical minerals as subsidies in disguise. So Australian, some of the miners, well, they will benefit from this guaranteed prices and guaranteed purchases. Even they don't have cost advantages, and even they cannot meet purity requirements for some of their outputs if they domestically produce. But this is a sort of a commercially benefits for those companies. But what about the entire decarbonization course? That means, I mean, we consumers, the industry will pay more for the green energy transition because we have to pay more for more expensive critical minerals. So I'm not sure how we can balance these security requirements and decarbonization requirements in the future.
Marina, really great to have you with us. Marina Zhang, who's an associate professor at the University of Technology, Sydney, and staying on this issue, the sensitivities of geopolitics and where it meets technological dominance. We're hearing now that the US, via the Commerce Secretary Howard Lutnick, has expressed concerns to ASML. This is, of course, Europe's most valuable company. The senior leaders in that company, that one of its top-of-the-line machines may have made its way into China, which would be in violation of US-led export restrictions. ASML has pushed back on that suggestion, explaining that none of its extreme ultraviolet lithography machines are in China. A company spokesperson saying that they've never shipped an EUV machine to China, but senior administration officials saying they've evidence that ASML has not acted in good faith, such as exports to China of gear specifically related to EUV tools, which the company has also then denied. So in a series of meetings, we're hearing that the Commerce Secretary Lutnick expressing concern over this technology. This is according to people familiar with the talks. We know that EUV systems are used by firms like Taiwan Semiconductor to manufacture processors for the likes of NVIDIA, for the likes of Apple, and ASML has never been allowed to ship them to China because of the curbs that were imposed under the first Trump administration. So we do have pushback from the company. They've explained that none of these tools have been shipped, but we continue to see lots of questions, particularly as to what has prompted these questions as well from the Commerce Secretary. And we are hearing that in private, the company has gone into crisis mode. We'll get more on this story in a few minutes' time. This is Bloomberg.
Take a look at how we're trading across the Asia session today. The Nikkei up 0.8%, extending that record high. We're talking about 7 sessions of gains. We haven't seen such streak of gains since last year. Of course, we're watching the Japanese yen very closely, strengthening a little tiny bit around the 161 level against the US dollar as Finance Minister Katayama speaks, talking about taking bold action against speculative FX moves. You have the Kospi also rallying today, reaching record highs again and surpassing that 9,000 level as the ASX 200 is as the ASX 200 is one benchmark that's losing ground at the moment, 0.9%. Right, and of course, continuing on that story, the U.S. now telling the ASML it's concerned China may have top chip tools. The Commerce Secretary Lutnick expressing those concerns to ASML's senior leadership. This, Bloomberg has learned, of course, is a key issue, especially given that it could be a big breach of Western semiconductor export controls. Let's bring in technology executive editor Tom Giles. Tom, how significant is this?
Yeah, if this is true, this would constitute a major, violation of, as you said, these export controls that the U.S. has placed not only on U.S.-based companies, but it's also imposing limitations on the kinds of exports, the kinds of transactions that happen between other countries, such as the Netherlands and Japan, major U.S. allies. And this is all part of the big picture here is, as we've discussed so many times on your show, U.S. efforts to basically make it more difficult for China to get its hands on the most advanced AI equipment. And of course, ASML is the maker of these big EUV machines that are used in the manufacture of the most advanced chips. And if one of these were to end up in China, and these restrictions have been in place for several years now, dating back to the first Trump administration, that would be a major violation. Now, to be very, very clear, ASML has denied that it has that any of this is going on. It's denied that there are EUV machines or even one EUV machine. It has denied that it has played any role in the export of even the kinds of tools that are needed to transport and to basically fine-tune EUV. So ASML is very clear in its statements to us and its statements to the U.S. government.
And to kind of put into context, the lack of access to these types of machines is really the biggest hurdle that China and China's companies are facing. Is that what we're hearing from the likes of Huawei, or is there a workaround that they've been managing to find?
I think if you talk to the chip experts and the chip manufacturers in China, they will tell you that they are finding ways around it, but there is no actual immediate and comparable substitute for these EUV machines. Remember, these go for hundreds of thousands of US dollars. They're the size of a school bus. They're incredibly sophisticated and complicated. And it's not like you can just kind of tear one down and replicate it immediately. It represents years and years of advanced fine tuning on the part of ASML. And this is the thing that makes ASML such an important part of a linchpin, if you will, in Europe's efforts to advance its own chip-making capabilities, and it has made ASML the most valuable company in Europe, and it has made ASML integral to this larger trade war that we talk about every day that is playing out between the West and China.
Technology executive editor Tom Giles there. Now, Alibaba Group Chairman Tsai says AI will create a $50 trillion economy, and the company has the will to shift its capital expenditure plans accordingly. He spoke exclusively to us at the Viva Tech Bloomberg Awards in Paris, recognizing the company's founders and leaders shaping the future of technology.
We always say when the world changes, you have to change. You have to change yourself. And we saw this coming. Especially we're in the era of transformer models and generative AI. And felt that this was definitely the direction, but it requires a lot of will, a lot of capital to be invested. And in order to do that and turn things around toward those, pretty heavy CapEx investments, you really have to have the will to do it. And we did. We decided that this was going to be the future. And I've said this earlier today, AI is not just about a technology that is going after the IT budgets or the software budgets of enterprises or consumers. It's going to be, the TAM in AI is a $50 trillion economy because it's all about human productivity and human intelligence. And roughly in the world, there's about 110 trillion GDP, and about 60% of that is labor, right? So AI is going after that segment, and it's going to be huge.
Jeanette, in this environment, I guess capital alone isn't enough. So what do you see the role of investor to be? Is it, build companies or actually also instill a bit of competition between the regions?
Actually, I think what you said is really interesting. So if you look at the position Europe is in relative to China and the US, we have a different problem to solve. You're building a lot of, very strong AI capabilities, and so is the US. I think from a European point of view, exactly the service and the sort of the 50 trillion service market is something that we cannot afford to lose. If you look at the gap between European and US GDP is roughly 12 trillion, and that exactly is sort of the accumulated market capitalization of the big five, and that's only services. If we now think about labor, and we don't lean into actually owning our own destiny in terms of building all the technology from energy to infrastructure all the way up to the application layer, at least to some degree, then we will be seeing the largest involuntary transfer of wealth from Europe and quite frankly other regions of the world towards the US. So I think it's just something that, as much as I work with an American company, as much as I love the US, I kind of feel like we do need to do something about that. And so that's why I do what I do, and that's fundamentally where I feel like the direction of travel is and where the most ambitious founders are building towards.
And the role of investors. Joe, talk to me a little bit about, if you become of scale, a very, very big company like Alibaba, then the challenges also differ. What do you see as the biggest difference in changing direction or actually getting things done at a larger scale compared to a small startup?
Well, the difference going from a marketplace business, which is capital light, into AI. In AI, you have to deploy capital, and we become a heavy balance sheet company pretty quickly over the last few years. But I don't think there's a fundamental difference in the sense that in both types of businesses, you have to make investment, and you're investing for the future, and you have to have a view of where the future is going to be. And if that view is very clear, then you could have a high degree of confidence on the ROI of that investment, whether it's investing in a capital light, software type capital light business, or you're investing into consumers and things like that, versus CapEx investments. I think it's financially it's the same thing, from an ROI standpoint. But I think that the biggest differentiator is you need to have a view of what's going to happen in the future.
That was Alibaba Group Chairman Joe Tsai and General Catalyst Managing Director Jeanette Zhu Furstenberg. They're speaking with Bloomberg's Francine Lacroix. More ahead on the Asia trade. This is Bloomberg. Take a look at some of the top global headlines that we're following this hour. And a bipartisan duo of senators has called on the US Treasury Secretary Scott Bessent to pressure China into addressing its exchange rate policies. Elizabeth Warren and Rick Scott told Bessent in a letter that the yuan is undervalued relative to economic fundamentals. They also called for labelling China an exchange rate manipulator in the Treasury's next foreign exchange report. Hong Kong is set to launch China government bond futures as Beijing seeks to promote global yuan usage and attract foreign capital. The Securities and Futures Commission is targeting the launch of 5-year CGB futures on August 3rd. It follows the expansion of onshore bond futures to qualified foreign institutional investors announced in April.
And take a look at how the Japanese yen is trading at the moment. Of course, significant weakness, a little bit of strength perhaps against the US dollar, but we're still talking about levels that we haven't seen since July of 2024. We're firmly on intervention watch as we're now hearing from Finance Minister Katayama that Japan can take bold action against speculative FX moves. There's no change in the stance on currency. Of course, these are words that we have continued to hear from the government. We're now hearing from her as well that Japan won't rely on debt to fund food sales tax cut. This is something that the government has said in the past as well, given those fiscal concerns have pressured the JGB space here in Japan. We also heard from the Bank of Japan Deputy Governor Himino about bond buying, that it isn't necessarily the BOJ's monetary policy tool now. Of course, the Bank of Japan just hiked rates this month, although the Japanese yen weakness has continued. We do have a few markets away today. Mainland China, Hong Kong, and Taiwan. That's it from the Asia Trade. The China Show is next. This is Bloomberg.